Gold retreats after a stellar run, and Goldman Sachs is back on the metals case, urging investors to short it. Our next guest has some thoughts on the matter. Carley Garner is the co-founder of DeCarley Trading, and she joins us now from Las Vegas. Carley, thanks for being back with us.
Thanks for having me.
So gold down from the one-year high it hit last week. Analysts at Goldman Sachs remain bearish, and you say it may be too late to get aggressively bullish. Why is that, Carley?
Well, we've seen gold run roughly $200 from low to high from December through last week. And so, gold's the type of market that punishes people severely for being late to the party. And I just have a feeling if you're bullish, your best bet is to be patient and wait for a little bit of a pullback before putting anything aggressive on.
Right. So you suggest there will be opportunities for investors to get into the gold market. So where do you see prices headed over the longer term, and at what price point would you be jumping in here?
Okay. Well, I believe that gold has the potential to see 1450, 1500 at some point within. It's hard to put a time frame on that sort of thing, but maybe within the next 6 months to a year. So I think there is some more upward potential here. But as far as levels I'd be looking for as a place to maybe key off on getting bullish, I think there's a chance that we pull back somewhere around the 11 to the 1150 area. That would be a 62% retracement of the last run. And, maybe even as low as 1100, which would signify the uptrend channel starting from December. I'm sorry, not channel, the uptrend line starting back in December through today's trade. So somewhere between 1100 and 1150 is, I think, where you can get comfortable on the long side. Up at these levels, it may work out in the long run, but it's going to be a rough road.
And I know you often speak of the 1215 level, so let's talk about that.
Right. 1215 is really just kind of a major pivot area. That represents where the market broke out from a long-term trading range. And last I checked, we were hovering right in that general area. So it's kind of make or break time. It's possible if 1215 holds that we don't get the pullback to 1100, 1150 area, and maybe we'll just go up from here. But I doubt that. I think the sentiment has changed enough that the market should go into a be bullish on dips kind of mentality, but I think the dips will be pretty large.
But Carley, help us understand, everyone got so excited when we saw that rally last week, and then, to come back this week and see the retracement here. What do you think is happening here on the gold front?
Well, I think a lot of it is, you have to keep in mind that gold is extremely speculative in nature. It's, the value that the market puts on it is more perception than reality in most cases. And so it's a market that more than others tends to overdo things, and it overshoots equilibriums. And I think that's exactly what we saw. If you go back to December lows, speculators were holding the smallest net long position that we've seen since 2002. So speculators had really kind of just thrown in the towel on the upside of gold. And once they saw the market moving, they were all rushing to get in. And so that played a big part in the rally and probably exaggerated things a little bit. It was, kind of the opposite of stocks, where you get the emotional panic selling, and gold, it's panic buying. And I think we saw a lot of that last week.
Carley, thanks so much for your thoughts today.
You're welcome. Thank you.
And thanks for watching this edition of Kitco's Gold Report. We'll see you tomorrow.